analysis and portfolio management. We'll basically be talking about the personal investment and the various choices for investment, and how the individuals make their choices, make their portfolios, and maintain their portfolios and revise their portfolios, so that whatever they are willing to do with their surplus money, that is achieved by them within a time frame that they are desiring. So this course will talk about concepts like security analysis, the technical analysis, the fundamental analysis, the portfolio management, construction, selection, revision, and all those aspects, so that the individual knows how to go about putting his or her money in a correct, asset, so that the capital is not lost and the desired income or the result or the return is achieved. So this entire paper is about the management of money by an individual in his portfolio. So the first concept that we're going to discuss today is the introduction to this investment environment. So before we actually go to what is investment, we should have a discussion on the like what is investment, why is someone willing to invest. Suppose right now I'm earning something, so the obvious thing, when I'm earning to consume certain things because I have some essential consumptions in hand. So after consuming, going for the essential consumptions, I usually have something left in my hand. Some amount of money, some wealth is left in my hand. So at that point of time, we usually think about investment, like what should I do with this money? Because maybe right now, today, what I am earning is more than what I require. Suppose my requirement is, let us say, 25,000 per month, but I am earning, let us say, 1 lakh per month. So after spending this 25,000 on my essential consumption, after that also some luxury consumption, some preferential consumption I can have, let us say that goes to another 15,000 rupees. So maybe I can end up spending 40,000 rupees in a month. Then I am left with another 60,000 rupees. So currently what I am requiring, what I require in life is met by my current income, and there is some surplus amount of income that I have in my hand. So I usually start thinking about where to put my money. The moment I start thinking about where to put this money, that is the place where the concept of investment actually starts. Because why do I need to save money? Now, if the 60,000 rupees that is left with me, I have the choice of putting that money in my own cupboard, in my home. I can store it, or I can put it in a bank. Now, the point is, if I am storing it in my home, the money, it is risky for me, because the money will lose its value if I store it in my home. Plus, if you imagine the things, the events like demonetization, if it happens, then the money that you have stored in your home, it will become really useless if you have that kind of an event. So I need to put my money into some place which will not only safeguard my principal but will also give me some return on it. Because why I need to do that is because maybe later stage in my life, when I'm, let us say, retired, I'm 65, 70 years old, when I'm no more earning, I don't have my regular monthly income, I don't have my regular salary, but I have a lot of expenditure at that point of time. Like medical expenses would have shot up, like other facilities that I require as a old age person, my requirements will be very high, but my income will be falling short of that, because now I have retired. I'm only dependent. I might have a pension, I might not have a pension. Even if I have a pension, my pension might not be sufficient to cover all the cost that I require when I am really old. So when we talk about investment is basically transferring your wealth from one time frame to the other time frame. So when I'm talking about transferring the wealth, like right now I need less but I'm earning more, so I have surplus income, surplus wealth. Now I will come to a age where I will have a lot of requirement but not sufficient income. So then I will have a scarcity of my wealth. So I need to transfer the surplus wealth from now to the period when it is going to be scarce. Now the process of transferring, this wealth across the time frame, that is from now to, let us say, 20 years down the lane. So this process is facilitated by the concept of investment. So the natural question might come: if I can save it in my own home, it will last for 20 years. But I just told you what could be the risk of storing it them in your home. Not only are you losing on the return, because storing in your money in your home doesn't give you any return. So not only you lose out on return, but you are also facing the risk of events such as the demonetization. So the when we talk about investment, it basically talks about transferring wealth from a period where your current consumption is less and you have surplus wealth with you, to a period where to a later period of consumption where you have scanty wealth, and I mean you have scanty wealth but huge requirement. So when we talk about the essential nature of investment, it basically means transferring wealth from the current position, reduced current consumption to the planned later consumption. Then we talk about what actually this is the nature of investment that I told, that transferring your wealth across the time frame. If we talk about the investment, how do I define this investment? Now, why do I invest money? Suppose the bank is asking me to deposit some money with them as in terms of fixed deposit. Suppose if I buy a share for a long period, I said that I have invested my money in a share, or I can invest my money in, suppose, in a mutual fund, or I can invest my money in gold, or I can invest my money in real estate. So I have so many avenues where I can put my money. But why do I invest? What is the basic purpose with which I am investing? That clarity will tell me what actually the investment means. Now, when we talk about investment, is nothing but a commitment of funds that I am making to some avenue so that I get some positive rate of return. This is important, positive rate of return, because many times the rate of return could also become negative. We'll discuss in subsequent classes how can a negative rate of return happen. Now, whenever I'm committing my funds to some asset, some kind of an asset, which gives me a promise of some positive rate of return, then that is called investment. So that is my commitment of funds to something in hope of getting some positive return. That is called. Suppose I put my money in a bank fixed deposit. Now the banks are currently giving, for 1 year, they're currently giving 7% return. So when I'm putting my money in a bank, I am expecting around 7.5% of rate of return. So that is called the investment in the bank fixed deposit. Similarly, if I commit my fund to, let us say, assets such as the gold or the real asset, I might not have this kind of an explicit rate of return, like the bank promises 7%. I might not have an explicit rate of return like a 7%, but when I'm committing my funds to real estate or gold, I will get that return in terms of absolute value of the money when I make a sale of the gold or the land. Suppose I purchase a land at a cost of 50 lakh rupees and I sell the land at a cost of at a price of 80 lakh rupees. Then I am having a return of, in absolute terms of the money, I am having a return of 30 lakh rupees. Now that 30 lakh can be translated into return if I use the formula like the gain from the transaction divided by the purchase price into 100, that will give me the rate of return. So that also is investment. The investment could give you returns in either in a percentage terms or in absolute money terms. So that is why we're investing, that I'm expecting something positive out of it. So I'm committing my funds for this particular time and I'm willing to wait for, let us say, 3 years or 5 years or 1 year to get that particular rate of return. So that is called the investment. Now, investment can have different connotations if I'm talking about finance sense or if I'm talking about economic sense. In financial sense, investment is basically you are purchasing the shares or debentures or your post office savings or insurance policies. So financial sense, the financial connotation of investment means where you are investing your money, where you are committing your money to. But in terms of the economic connotation says that what is the net addition to the capital, the economy's capital stock? Because whenever I'm investing, I'm actually investing in some asset. The asset could be a real asset or it could be a financial asset. So whenever I'm putting my money into the asset, even if I'm putting my money in the financial asset, it ultimately finds its way to the real asset. So more the investment, more is the amount of the real asset. So the real asset in essence increases when we go for investment. More the investment, more the real asset, and more is the GDP of a country. So in economic sense, the investment is basically how much my real asset is growing. That is the essential nature of investment when we're talking from the economic perspective. But from the finance perspective, it is where I'm putting my money into. So that is how the investment is being defined. Now, if I say this, I'm talking about this concept of investment. Now, investment is always a trade-off. Like if I have X amount of money right now, let us say I have 10,000 rupees right now, then I can choose to either spend it totally, or I can choose to totally save it or invest it. Now, if I am choosing to totally consume it, then my investment will be zero, because I am going to entirely spend my 10,000 rupees, so my investment would be zero. But if I choose to entirely put my money in a bank, then my investment will be 100%. 10,000 rupees goes into the bank, and I don't get anything to consume. So essentially, when I'm talking about investment, it is I'm always trading off between my current consumption and my future consumption, or current consumption, because whenever the money comes after investment, when the return comes to me, maybe 3 years down the lane or 5 years down the lane, when the money comes to me, then only I can consume that. So basically, when I'm talking about investment, I'm talking about a trade-off between the amount available for me to consume now, vis-a-vis the amount that will be available after some time for consumption. Now I can explain that thing in a graph that I have shown you here. Now on the x-axis, I'm showing you current consumption, and on the y-axis, I'm showing you the future consumption. So maybe 3 years, 5 years, 10 years from now. Now you see, suppose you have, let us say, 55,000 available with you, right? Now, if you have total amount of, you have 50,000 available with you. Now, if you consume it entirely, so see, when on the x-axis you have a point of 50,000 rupees. So if you consume it entirely, you have zero amount left for the future. But if you consume, let us say, 30,000 of it, and the remaining 20,000 you invest, right? Suppose you invest that in a particular asset, so you will get a rate of return. So this kind of a trade-off is there between the current consumption and the future consumption. Now suppose the entire amount of money you decide to invest, let us say you invest it in a mutual fund which gives you 11% rate of return. So in that case, you will get 11% on 50,000 is 5,500 rupees. So if it is 10%, then you get 5,000 rupees. So you're let us say in 3 years time, you get 55,000 rupees. So you get 55,000 as your current future consumption. If you're entirely consuming it, you have only 50,000 available for you. If you're willing to wait for 3 years, 1 year, because I'm talking about 10% rate of return on 50,000. So if you're willing to wait for 1 year, your amount will grow by another 5,000 rupees. So it will become 55,000 rupees. So that you can consume in the future period. Now, there might be a question here that why will the money value increase if I'm willing to invest? Now, because you know the consumption, the current consumption as such is very pleasurable to any human being. So if I consume something right now, so if I ask you a question like, do you want a pair of clothes, like let us say pair of jeans right now, or do you want it in 10 days time, after 10 days time? Your immediate answer is going to be, I want it now. Because human beings programmed in a way where they always want consumption to happen right now. So if I am required not to consume now but to postpone my consumption, that gives me certain kind of a pain which need to be compensated. If I have to postpone my consumption, then I don't like that scenario. So I need to be compensated for that, and that compensation is the return for this particular investment. So when I'm not consuming my entire amount and I'm putting it in a bank, I'm getting a higher amount. So here I can split my 50,000 rupees in any way I want. Let us say if it could be 30,000 consumption, 20,000 your investment. It could be 15,000 consumption. It could be 35,000 investment. So everything will plot on this particular graph, as you see. Depending on, you can put your money, whatever money you have, and the remaining amount you are saving. So that is the basic nature of your investment. Now, in this investment scenario, you will frequently come across three terms that we normally use interchangeably. Like there is something called investment, then there is something called investment and savings, or speculation and gambling. Now, many people confuse the speculation with that of the gambling. Now, but that is essentially these two terms are very different from each other. So we'll try to see how this speculation and gambling they vary. Now, in speculation, the concept of risk and uncertainty, that is the actual defining concept, the differentiating concept between the speculation and the gambling. Now, if I'm basically putting my money into something, the return of which or the outcome of which I am not sure of. So I'm unsure or I'm uncertain about what is going to happen regarding the bet I'm going to make right now. Okay, so if I'm putting my money into something, I really don't know what kind of a surprise I'll get. I'm really uncertain. I have no clue regarding what will happen in future. So that is called the concept of gambling. For example, if I bet on without proper knowledge, if I bet that tomorrow the dollar value is going to be stronger, then I'm basically gambling without having proper knowledge, as I said. But if I am speculating, I am taking a calculated risk. Now, suppose I have perfect knowledge of economics and I know the probability or I know the chances of that the dollar value will increase tomorrow, and then I put my money into the dollar. Then I say that it is said that I am speculating, because if I do it with perfect knowledge and having calculated the probability of the dollar going up or down, then it is called speculation. So because I'm taking a calculated risk. But in gambling, there is no such thing. For example, whether the train will be, there is a cricket match going on and we are betting on a particular team winning. So that's gambling. Okay, because we really have no fundamentals to, really predict the outcome of this particular game. So that is gambling. Whereas in speculation, you have some idea regarding how the fundamentals work, and you have some idea regarding which way the outcome will be biased. Like there is a probability or there is a chance of something happening. Then you are saying that I am taking a calculated risk. So that is called speculation. Now, the speculation always involves some sort of a positive expected return. So I'm always expecting the positive return from it. So I'm speculating, though it might sometimes result in a loss or a negative return. But why I'm doing it? Because I am expecting a positive return. So I'm taking a calculated risk. So I'm taking my chances and I'm expecting a positive return. But in reality, there could be positive return. There could also be a loss. That is why the name risk. Whereas when I'm gambling, the prospect is always negative. For example, the roulette wheel example. So you bet on a particular number. Let us say you bet on number 7 and you then rotate the roulette wheel. So you have no idea regarding where the ball is going to fall in which number. You have put a bet on number 7. So here the essential nature of this game is that it is going to be negative, because there are several other numbers out of which I bet on 7 without having the fundamental. What is the reason that the ball will go to the number 7? So this essentially is a gambling. Now, people become fortunate, by the way. They become fortunate, the luck favors them, and they sometimes win. But gambling also results in a lot of wealth loss for every individual. So the essential nature of gambling is negative, but the essential nature of speculation is it is positive. Now, a speculator usually buys or sells asset in the hope of making a larger profit than the amount of risk that he is taking. So he is taking X amount of risk, but he is hoping that he will get a commensurate or a better rate of return from that. and he takes the risk while knowing that the more risk that they take, the greater is their potential gain. So that is from this concept becomes the concept of higher the return, higher the risk, higher the return. They're also aware that when I'm going for a calculated risk, I'm also very sure, I'm also aware that I'm taking a risk. So risk means that there is a probability of loss as well. So you have, you know that you are going to, lose your money in the future, may lose your money in the future. So when I'm speculating, I basically have an idea regarding the probability of the outcome of an event. So I can relatively predict the outcome of an event. For example, if I toss a coin, I can say the chance of it falling head is 50% and the chance of it falling tail is 50%. So here I am able to calculate, though I don't know which side the coin will fall, but before tossing the coin, I really know that the probability of a head is 50%, the probability of a tail is also 50%. But you have no such calculation while you are gambling. See, in a roulette wheel, if you are betting on number 7, you really have no idea regarding what is the probability that the next rotation, the ball will go to the number 7. You have no idea regarding that particular probability. So if you can calculate some kind of a probability to the outcome of an event, it is called speculation. If you cannot do so, then it is called the gambling. Now, as I told, gambling is completely different from the speculation. It is purely a game of chance. There is no mathematics involved here. There is no logic involved here. Now, usually the odds are stacked against the gambler. The one who is gambling, the odds are always stacked against. So, you always use the terms, the odds in case of the gambling. Now, while you are gambling, the chances of losing an investment is usually very, very high than the chance of winning that particular investment. For example, in a roulette wheel, the ball going to number 7, the chance is only 1. Whereas there are, let us say, several other numbers written around the number 7. So there are the chance of losing is very high and the chance of winning is very low. It is only by luck that you win that particular chance. So it is the outcome is absolutely uncertain and the risk of loss is very, very high as compared to the speculation. Then we talk about, speculation is positive, as I told, gambling is negative. So when we're talking about the SFDM course as a whole, we'll not only talk about this investor, we'll also talk about the speculator, because the speculators who keep the market vibrant. Now, how is the speculator different from an investor? That is also an important segregation that we need to make here. And you see, usually the speculators are chasing the profit. So the time horizon for their investment is usually very short. Okay, so because they're chasing the profit, so they will try to make quick profits. So they will engage in trading activities like buy, sell, they go on doing that. And they make profit. So the time horizon of a speculator is relatively short as compared to the investor. Now, investor is putting his money or her money with an expectation of return over a very long period of time. So I might buy something and then I keep it and then I forget. I don't touch that asset until I require it in future to be sold off. So similar, for example, if I have put my money in a bank fixed deposit, for 1 year I don't touch it. So it's fairly long. Whereas in speculation, you buy a share and you sell a share. It can happen the same day. It can happen in 3 days or 5 days, even 3 months. So the time horizon is short for speculator and it is long for the investor. Now, the investor expects a good return and consistent performance, but the speculator expects a flamboyant return and over a very short period. So suppose I am, for example, I am buying a share. What I am willing to do is I am willing to wait for, let us say, 5 years. I am going to get some annual dividends, interim dividends. I am going to get some dividends, and at the end of 5 years, I am going to sell the share for a higher price as I purchased. So I get a return out of it. So that's called a good return. But the speculators, they want a very short term and quick returns, and so what they do is let us say buy a share at 55, sell it at 80, so you pocket a profit of, let us say, 25 rupees there in 2 days, 3 days, or in the same day. So you make quick profits and in very short durations of time. The investor usually sticks to his or her investment. The whatever investment you have made, the investor usually sticks to it. Whereas the speculators doesn't stick to the investment. They quickly move from one investment to the other investment because they're always chasing the small profit. The investor is usually any investor is usually risk averse, but the speculator is a risk taker because he is chasing after the small profit, so he is willing to accept some amount of risk. Whereas the investor is always trying to avoid that amount of risk. So many times, what happens is the risk that the investor is trying to avoid is usually taken up by the investors. So that is the difference from the risk point of view. Now we talk about the investment objective. Investment objective, when we talk about when an individual is making an investment, he has something in his mind or she has something in her mind that why I'm going to invest. Maybe suppose I'm putting my money into a bank account with the purpose that let us say in future I need to have some modification, alterations, or some kind of a repair and maintenance activity for my home. So I might need the money in 1 year time. So I'm putting it in a bank account. If I'm planning that I'm going to invest my money from now onwards until next 20 years so that it can finance my child's education, so that is a different kind of a goal. So because every goal has a different kind of strategy, so you have to strategize as per the goal. So the first place, when we're talking about investment, I have to understand that every individual has a certain objective or certain goal for which he is putting his saving his money or investing his money. So these set of goals of individuals, now the goal is not one, like the goal is not like my money should grow. Your goal could be of different types. For example, you might need growth of your capital, that is your goal. You might require that my principal should be safe, that could be your goal. You might want that I must get some regular return, regular income from my investment, that is one kind of a goal. So the individuals have different set of investment goals. And when these kind of goals will determine what kind of a portfolio I'm really going to have. Because if my primary goal is that my money should grow, then my portfolio will look different. If my primary requirement is that I should get regular income, then my portfolio will look different. If I can also want that my principal, safety of principal and the growth should be combined 50-50, then my portfolio is going to look different. So the various investment goals of an individual define the portfolio structure of that particular individual. So you need to in the first place, you need to identify what the investment objective really means. What is the investment objective of an individual? Now, if at this juncture, it is really important to discuss this concept of risk tolerance. Now, risk tolerance is how much the individual is willing to handle the risk. Now, for example, suppose I put my money in the bank. The bank, I am sure that the bank is going to give me a 7% or 7.5% return after 1 year. So I can relatively be at ease if I'm putting my money into the bank. Because I know my principal is guaranteed, my principal is not going to erode, and I'm also going to have the benefit of 7.5%. But if I want, my goal is that the money should grow quickly. If my goal is growth, then I am not satisfied with the 7% return. So maybe I want something like a 14-15% return. So in order to get that 14-15% growth of my money, bank fixed deposits are not capable of giving me that rate of return, that growth. So what I need to do is I need to probably search for investment assets such as the shares or the mutual funds, which really can help me achieve my particular investment goal of growth of my wealth. So then I think about buying a share. Now we all know that shares are risky investment because neither it guarantees my capital nor it guarantees gain or the growth of the capital. Because as we know, the shares are the ownership capital and they are the uh, permanent capital and the ownership capital, and there is a lot of discretion regarding payment of dividend. So it is at the discretion of the management whether they will pay you dividend or not. So you really don't know whether the share you are buying is going to give you dividend or is going to appreciate in value so that you can sell it off and you can get some return. You have no inkling about those things, but still you are committing your fund to the share. Whereas there is another individual, he is not willing to commit his fund to share, he is only going to stick to the bank fixed deposit. So we say that the individual who is not willing to part with his money for a risky investment is called a risk avoider, because his financial risk tolerance is very low. He is not willing to tolerate any financial risk. The person on the other hand, who is willing to put the money in a share by rejecting the offer of the 7% of the bank, is willing to put his money in a share because he wants a 15% return. He is a risk taker. He's basically chasing risk and he's a risk taker, and his financial risk tolerance is very high. So I have this with these goals, the financial. Now I am wanting growth, but I am a very risk averse person. My financial risk tolerance is very low. Then it's very difficult to construct a portfolio. You need to understand this concept, because if you are going to chase growth of your capital or your money, then obviously you are going to take some amount of risk. So if you are not at all risk tolerant, it is difficult for you to design a portfolio like that. Okay, so that is the two intertwined concepts: the financial goal and the risk taking ability or the risk tolerance. There are two intertwined concepts that we must understand. In the second step, once we have understood this goal of an individual, then using that particular objective, the financial advisors, he determines the best strategy for achieving your objective. Now, as I told you, like if you are a student and you are willing to save some amount of money so that in 3 years time you are going to pursue an MBA degree which is going to cost you around 20 lakhs. How do you go about it? So you start saving from now on. So you don't want any regular income, because all your needs are being taken care of. So you want all the money to grow in value. So you will choose a portfolio which has no regular income, which will not give you any regular income, but it will give you fabulous growth. So at the end of 3 years, your money grows to 20 lakhs. So that is what you want. So maybe for you, the portfolio that the wealth advisor will choose is an asset which appreciates really fast in time. It might be a share, it might be gold, it might be real estate, it might be something like that, which doesn't give you a regular income, but it assures you a very hefty rate of increase in the value of the asset. Similarly, if let us say, if I'm talking about designing the portfolio of a 60-year-old or 65-year-old man, then I know that he's either retired or on the brink of retirement, and once he's retired, his regular income or the regular salary is going to be stopped. His the earning potential of that particular individual is drastically going to reduce, but his medical expenses are going to shoot up. I know that, because the experiences tell us that the older the person, the higher the medical bill. So his expenses are going to shoot up. So if can I design a portfolio for him which does not give me, like the student, I invest the money in a real estate with the hope that the real estate will give me a fabulous return when I sell it in 5 years time. Can I do that for the old man? No, I cannot do that, because the old man needs the regular returns. So for him, maybe the best strategy of his portfolio should have more amount of assets which give us income at a regular interval of time. So such as the debentures of the bonds, I can invest in that, or the post office savings, or this kind of which gives us the regular income, I can invest in that. So my investment objective will decide my portfolio. I cannot use your investment objective and decide my portfolio. So every individual's investment objective will determine the kind of portfolio that he or she is going to have. That's the second step. Third, the risk tolerance and the time horizon of the investor, that helps in investment, having an investment goal. We have already discussed this concept of this risk tolerance, and now we talk about this time horizon. Like, do you want fast growth you want growth in 3 years, you want growth in 10 years. So then, of course, you have different assets to choose from. Like whether you want a 10% growth in 3 years time, or a 10% growth in 5 years time. So you need to have different portfolios, because not just the risk tolerance, you also have to now look at the time frame within which you want to achieve this particular objective. Suppose if I'm talking about my child's education, that is, let us say, 10 years from now. But if I'm talking about my child's marriage, then probably that is 20 years from now. So for a 10 years, so for my financial goal of the child education, I will plan a portfolio different way. But for the purpose of my child's marriage, I'll plan it in a different way. So time horizon also is important for the investment objective. So now, having understood the investment objectives, we talk about now what are these objectives. The investment objectives could be roughly categorized into this primary objective or the secondary objective. Now, when I'm talking about the primary objective, it could be these three that I have mentioned here: the safety, capital gain, or income. Whereas the secondary investment objective, so the basic purpose for which we're investing is called the primary investment objective, and the allied objectives that are always at the back of your mind, that is, those are the secondary investment objectives, the liquidity and the tax savings. We'll discuss each of these points one by one. Now you see, when I'm talking about the investment, these two things automatically come to my mind. I don't have to think about them. Safety, whether my principal is going to be safe, whether I'm going to get back at least my principal or not, how safe is my principal. Then the next is, what is going to be my gain. So if the capital gain part, that's called capital gain. Suppose if I buy something at 5 rupee and sell it off at a price of 10 rupee, then I have a profit that we call profit, or that is also called the gain, capital gain. So is it going to, whatever I'm buying now, will it have a good resale value? So that is the second thing that comes to my mind. That's called the capital gain. And last, whether will I get any income, any regular cash from this particular investment that I'm making, or is it that I'm just putting all my money into this asset, and only after 5 or 10 years, whenever I dispose of that particular asset, then only I'm going to get my return. So if you, let us say, if you talk about a real estate, a piece of land does not give you any return unless you are renting it out. Doesn't give you a return, but it's a piece of land that you have purchased and is barren, and after 10 years time you sell it off at double the price, then you get a capital gain, but in no income. Similarly, suppose if you invest in a bond, the bond does not give you any capital gain, because if the bonds don't really appreciate, only sometimes the companies redeem it at a 5 or 10% premium, then only you have some little bit of capital gain, but mostly there are no capital gains. You get regular income. So the bonds every 6 months will give you a return called the coupon. So bonds are the extreme example of coupon paying bonds, the example of having all income, no capital gain. The lands or the shares which do not pay us dividend are the examples of assets which only give me capital gain and no interim income. But at the back of my mind, I must have this thing that whether my principal is safe or not. Wherever I'm putting my money, is my principal not going to vanish? Is it going to be safe or not? So that's the first concept. So the primary investment objectives. At the back of that is the second investment objective. Now, the first is liquidity. Now, the meaning of liquidity is, well, I'm putting my money here, but what if I urgently require my money? Suppose something unforeseen comes up and I need my money. How quickly can I liquidate? How quickly can I convert this asset into cash? That is called the liquidity. So, if let us say you are talking about a land, it's very illiquid. It cannot be immediately converted into cash. As we all know, if you want to do it, then you have to suffer a huge loss. So that's not liquid at all. Let us say fixed deposit. That's very liquid. Any point of time you walk into a bank and get your cash deposit liquidated, and you get the cash immediately. That's very liquid. Now you talk about the shares or bonds. They have relatively very good liquidity, because you can dispose of the share at any point of time. Well, in 2 days time, you'll get back your cash. 1 day or 2 days time, you get back your cash. That they are liquid. So whenever I'm investing, the first thing that comes to my mind is how quickly I can convert, because I might have some unforeseen circumstance which will require me to have the cash back. So liquidity, and of course whether it is giving me the tax savings, tax benefits or not. So that is the second investment objective. Now, having discussed that, where can we invest? That is called the investment environment. Where can we invest? Now, when I'm talking about where can we invest, you can have several instruments. I've just given you a brief idea about the kind of investments that we're having. But these days, multiple avenues of investments are available. For the purpose of this introductory class, I'm only going to discuss these things like the stocks or the shares that we call them, like they are traded on the stock market. They are usually the ownership capital of a company. When you buy a share, or a stock, or when you buy them, you don't get back the principal, because that's a perpetual capital and you become the owner of the company. So you don't get back your principal. You only get the income in terms of dividend from the company. If you want your principal, you will have to sell your stock to somebody else in the market. You can do that in the stock market. So, and in lieu of the stock, you get voting rights, you get the right to control, you have rights on every stock. So, a lot of advantages of the stock, a lot of disadvantages as well, because the dividend is completely discretionary. Like the management will decide whether to pay dividend or not to pay dividend, and how much dividend, if at all, how much dividend. That's the stock. You can invest in the bonds. Bonds are usually loan capital issued by the governments, municipal bodies, corporates. So all of them, they issue bonds whenever they require money from the public to be mobilized in terms of not ownership but loan capital. Then these bodies, they usually issue certificates called the bonds. If I buy a bond, I'm essentially lending out my money to that particular entity for the amount of bond, for the amount that I have purchased the bond for. Suppose I buy a bond for 25,000, I'm giving a loan to that particular entity for 25,000. So in lieu of the bond, I get the interest, and I also at the end of the tenure, I get my principal back. So principal is guaranteed here. Next, you have the mutual funds. You have the mutual funds. Now, the mutual funds, many times the people are not very confident of picking the stocks on their own. So they depend on the professionals who can do that for them. So they, instead of making their own portfolios, they depend on professionals, the asset management companies, which pool together the small capital of individual investors, and then make it a big corpus, and then sell individual units of it, which is called the mutual fund. So these mutual funds, you get the advantage of the corporate expertise. You don't have to use your own skills of making the portfolio. You can get the skills of the professionals through the mutual fund. Then you have the index funds, like you have the indices of the various stock exchanges, like BSE has the Sensex, the NSE has the Nifty. So if you design your portfolio exactly copying the Nifty or Sensex, that's called an index fund. So you can exactly copy and the return will also imitate that of the Nifty or Sensex. So that's called an index fund. Now you have the ETFs, the exchange traded funds. These ETFs have the index funds are not traded in the market. The ETFs are traded, and their values are determined like the shares, the values are determined every day. These are also determined every day. Whereas the index funds, the values don't fluctuate that much. Then you have the options. Of course, these options are a complicated set of investment options. I mean, investment avenues or instruments where you have the right to buy a share at a particular time, and at a particular time and at a particular predetermined price, but you don't have the obligation to do so. So if you suppose, for example, if I give you an example that SBI share currently is trading at 2000, but I want to buy it in March and I don't want to pay a price of more than 2500 for that SBI share. I don't know which way the SBI share is going to move. If I buy a call option on the SBI's shares, I have purchased a call option. So in March, if the price of the share is more than 2500, I exercise my option of buying it at 2500 from the person who has sold me that particular option. But if the price of the SBI share is less than 2500, I don't have to necessarily buy it at 2500. I can choose to discard my option. So that's a different category of investment instruments. So that's the option. Now, in the investment environment, you have another big player. These are the financial intermediaries. Now, these are the intermediaries who, like for example, if I am, they are the intermediaries who ensure that your finance, the money that you have with you reaches the requirer of the fund. For example, the corporates, I have the X plus fund. The corporates require the fund. Now the people, the organizations which ensure that my fund goes to the corporates through whatever means, that is called the intermediaries. Now these intermediaries could be banks, they could be insurance organizations, they could be the the BFSIs, the banking and financial sectors, the investment bankers. So this could be anybody. Similarly, you have all these things, these financial instruments, intermediaries, all of them, they are operating in the entire domain of the financial market. Now, when we talk about the financial market, the markets could be the primary or the secondary market. So we know the primary market by the more popular name of, let us say, the new issues market. Like this is the place where this is the market where the companies, they sell their shares for the first time. So companies issue the shares and the buyers directly buy from the companies. That happens in the new issue market. Whereas in the secondary market, what we do is they already sold shares, these shares that are sold in the new issue market, the owners of these particular shares, they sell off to new owners in the secondary market. So secondary market is basically the stock market. So both these primary market, so the companies, there is a fund flow to the company from the new issue market or the primary market, but there is no fund flow to the company from the secondary market. In the secondary market, the fund flow happens between the investors, the secondary investors. So this investment environment consists of all these things: the intermediaries, the financial markets, and the instruments. Now, lastly, we'll talk about this process of investment. Now, having understood, we have discussed the what is why an individual invests, what is his purpose, why he is making an investment, what do you mean by investment, then the goals that the person is chasing to invest, and then what is the investment environment, how it looks like, which are the entities that you would encounter if you are going to the financial market. Now, if I'm talking about the investment process, it is the SFPM is all about this entire investment process. So the entire course is about this investment process. But for today's introductory class, we'll just have a discussion on this process as a whole. Now, the investment objectives and the policies. Now, we discussed that what are the investment objectives of the individual. Suppose by policy, what I mean is, let us say, if I talk about the investment objective of a bank, let us say. Now, banks are mobilizing our deposits, so and they're promising a rate of return. These money that they get by mobilizing the fixed deposit, the bank has to invest somewhere because it has to get a rate of return, and then they will part of the rate of return to us as our return on the fixed deposits. So now, when banks are investing, they have a specific policy in place. Or for that matter, if you talk about LICs, they have life insurance corporations or the other insurance corporation. They have a, when they're investing, they have a particular, or mutual funds, they have a policy like we will only invest in growth funds, or they will only invest in income, or you, how much of your money should go to share market, how much it should stay in the government securities. So you have a fixed policy. So while you are starting the investment process, the first step, of course, along with the objective of the individual or the corporation which is engaging in investment, is to really find out what is the policy of the organization regarding the investment. How much of it, for example, the policy might be not 20% of my entire fund or the corpus should go to the share market. So you should not exceed that, bypass that policy and exceed your investment in the share market, because then it becomes illegal. So we have to be very sure about the objective and the policy. Then, in the second place, once the objective and policy is in place, we talk about the investment avenues. Now, just now we discussed the bonds, the shares, the mutual funds, the index funds, and all those things we discussed now. Now you have to find out. And when I'm talking in shares, there are thousands of shares. When I'm talking about bonds, there are also thousands of bonds, thousands of mutual funds. So which specific fund or specific bond or specific share I'm going to invest, to be able to choose those specific assets, I have to do security analysis. Now, security analysis is about finding out a particular investment asset's risk and return profile. Now, see, risk, I can judge it from how it has been behaving in the past. So I can calculate the past return, and I can predict that particular, use several forecasting techniques to predict the future return. Now, along with predicting the future return, I have to also give you a probability. Suppose a share, saying that the share is going to give you a 15% return next year. Well, your next question is going to be, well, 15%. Are you sure it's going to be 15%? When you ask me this question, are you sure? So that basically asking me, am I 100% and am I giving you 100% probability? No, I cannot give you that, because nothing is 100%. So you will then ask me, no, I say, no, I'm not sure, but I'm pretty sure. So then you will ask me, how much sure, how much pretty, what is that pretty sure? So then I'll tell you, well, I am 80% sure that the return will be 15%. So then I'm giving you a probability. So that probability is risk. This calculation of the probability is the risk. What is the probability that that particular return will happen? That is the risk. So for every individual asset that you are considering for investment, you have to undertake security analysis. So basically, the risk and return profile, that is the set of mathematics to use to find out this risk and return profile. And having done this security analysis, you choose. There are thousands of investment avenues. You're not going to invest everywhere. Maybe you will invest in 30 or 40 or maximum 50 assets. You will have to pick up those 50 assets or 30 assets from this universe of the various instruments, financial instrument you have just seen. So which of those 30 or 50 you will pick is going to decide what your portfolio is going to look like. So which 30 or which 50 you have to choose, and you have to allocate your capital among them. So if you have 10 lakh rupee and you have chosen 30 investment avenues, so which portion gets how much of your capital, investment of your capital, that is called the profit, the asset allocation. Now, the choosing of the asset and allocation of the fund among your assets, that's called asset allocation, is the essential step of your constructing the portfolio. And from the same 30 assets, you can construct n number of portfolios by changing the allocation of your assets. So you can, and each of these portfolios, you can have n number of portfolios, and each of these n number of portfolio will have different risk and return profile. So depending on your investment objective, you will have to choose a particular portfolio out of that. That is the third step. Having said this, once you have constructed a portfolio, does it mean that my portfolio remains unchanged over a long period of time? No. You have to review your portfolio every time, now and then. For example, it might be an organization policy that the portfolios will always will be revised every 6 months. Maybe I, as an individual, I can think, well, I don't have that much of time to do the portfolio review. If I'm doing it for myself, I will do it once in a year. So, and why do I need to do it? Because the basic nature of assets, they change. Some other assets become more valuable. Some assets lose their value. So I need to rebalance my portfolio. So review my portfolio and drop some of the assets, include some of the new assets, maybe change the allocation of the portfolio, allocate the fund differently. So all these things will happen when I'm reviewing my particular portfolio. That's the next step. And review your portfolio. And how do you review? When you are reviewing, with the concurrent step is the evaluation. Now, if I am evaluating, suppose I constructed a portfolio today, at the end of the year, I evaluated the performance. I needed a 15% return from my portfolio, but my portfolio gave me only 13%. So how do I know that? I evaluate the performance. So there are different set of formulas and mathematics available to calculate this performance of portfolio. It's not very simple process. There are specific formulas available and there are logics for that particular formula. So you evaluate the portfolio in terms of the rate of return that has given you. And if your investment objective is not being met, the obvious choice is to review the portfolio. I mean revise the portfolio. So you review and evaluate, and then you revise your portfolio. So how do you revise the portfolio? You might have a specific formula in place how I am going to revise, or maybe you can just do another kind of you can go back to step one, like the investment objective, and then start again the process. Well, security analysis you have completed. Now you are revising, going back to step one and redoing the process. So you form a new portfolio. Again, construct a portfolio, review the portfolio, evaluate the portfolio, and do the revision of the portfolio. So this is a continuous process. Investment is not a static one. So, and it keeps on changing because the risk and return profile keeps on changing. The portfolio risk and return will keep on changing. And if my investment objective is being met, well, I don't need to review. I mean, I don't need to revise my portfolio, but I need to review. A review, know that it is giving me my achieving my objective, then keep it static. But if it is not doing it, then I have to revise my portfolio by dropping some and including some new assets. So I guess with this, we come to the end of today's discussion about the entire overview of how the investment looks like, how the investment process, starting from how do we define investment to how we look at the investments in terms of return that I want and the risk I can bear, to how the investment environment of the entire, the environment, the entire country, how it looks like what are the markets, what are the intermediaries, what are the assets available, we have to know about that. Then the investment process of choosing the ones that I want for my portfolio and then revising my portfolio. So the process ends there. So it's a long process, and this is the entire course of this particular paper. And I guess we'll know more about each of these steps in the subsequent classes. Thank you.